Are you in a money bind? And did you know you can actually borrow from yourself? Well, keep watching to learn how you can take a loan from your life insurance policy and make more money with it. All right, first let me explain how whole life insurance policies work, how they have cash value, and how you can do withdrawals and loans, all right? Now, one thing, I said how you can borrow from yourself. The truth is, you don't borrow from yourself. Whole life insurance policies are a little bit different than like term life insurance. Term life insurance policies are just death insurance. You have to die for somebody else to get paid. So really you pay for someone else to make money off of you, right? So that's what it is. It's just a basic death insurance when it comes to term insurance. Now when it comes to whole life insurance, whole life is permanent insurance. It doesn't go away after so many years. It's for your whole life, hence the name whole life insurance, right? But the nice thing is, it's not just a death benefit, it also has this thing called cash value, which is also what I refer to as this tax-free, supercharged savings account. Because with this cash value, you can actually use this money for whatever you want, right? This is money that grows in there tax-free, comes out tax-free. This is beautiful. It's kind of like a Roth IRA, but you don't have to wait till you're 59 and a half to access it. That's the beauty of it. So this cash value can grow. Now, here's a warning. Not all whole life policies are the same. Not all companies are the same, and definitely not insurance agents are definitely not the same. Most whole life policies that you hear about that have a bad rap are the ones that most insurance agents write, which are crap. I agree with them. They are the type of whole life policies, because whole life policies are front loaded with their costs. They're more expensive in the first years, and then the costs get cheaper as time goes on. Problem is, most agents do it the traditional way that insurance companies teach them how to do it, which is all of your money, all the cash you're paying in for those first 2 years, pay for the insurance costs. It all goes in, it pays the insurance costs, including the agent's commission. They make a lot more money when you do it that way. I recommend doing like what we refer to as max ROI infinite banking, which is you get the lowest costs coming out of it possible while you put in the cash in there. So it's the lowest cost with the most cash able to go in, allowing your cash to grow. Yes, you won't have as big of a death benefit, at least not early on, but you will have cash from day one that allows you to grow that money tax-free. Oh, and as a bonus, it's free from lawsuits and creditors in most states, 100% protected. Meaning that if you get sued or somebody says you owe us money, doesn't matter, they can't get to it even if you have millions of dollars sitting in this cash value account. That's the beauty of it. Now, this is not an investment, this is really just a savings account that you're able to use, right? This cash value is in there, growing in there. Now, you can do one of two things. This is how you can access the money. You can either withdraw the money, just pull it out like you would from a savings account, and you can do that, or you can get a loan. Now, someone will say, Chris, wait a minute, why would I pay interest for my own money? That's ridiculous. Why would I do that? I would just want to withdraw it. That's what I used to think too. But here's why. Understand that when you have money in a policy or money in any kind of account, savings account or anything, when you withdraw that money, it's now lost the ability to earn interest, right? So say you had $100,000 in there, you pull out $90,000 of your savings account, only $10,000 earning interest. It's almost like you're starting over again. Where at $100,000 you were making a lot more interest, right? Well, in a savings account you really weren't making that much more, were you? But in life insurance where you're making at least 4, 5+% tax-free, it makes a difference. So what we do instead is we get a line of credit against it. You can get a loan against that money. You don't borrow your own money. You borrow the money from either the insurance company or from a bank. And when you borrow the money, they do charge you interest that you pay back to them, not to you, to them. But here's the difference. That $100,000 is all in there working for you. So even if you have a $90,000 loan that you're paying to them, the good news is you're earning more in compounding interest, if you do this right, than what you're paying to them in interest. So you end up making money here, and then that money you've pulled out, you can use it for whatever you want. And we'll talk about that a little bit later, about some cool things you can do with it so that you actually make money in two places at the same time. All right, so that's how the loan works, right? You're able to get that loan out. Here's a great thing. When you get a loan out from an insurance company, you can pay it back however, whenever you want. The deadline for paying back that loan is your death. And what do they do then? They actually just take it out of your death benefit. So say that you have $500,000 of loans that you've pulled out, right? And you didn't want to pay it back at all. You just let the interest accumulate over time. Well, good news is if you have, say, $2 million of death benefit, well, when you die, they pay off that $500,000 loan, they pay themselves back, and then the remaining $1.5 million pays to your family tax-free. That's right. Not only does the money grow tax-free, comes out tax-free when you want to use it, but when you die, that death benefit pays tax-free as well to your family. So that's how the loan works there. So you got that money that's able to work for you. So again, no monthly payments required. It doesn't show up. It's a private loan. So it doesn't show up on your credit at all. It's just purely a private loan that you have with the insurance company. You can pay it back however you want. Now, I would recommend, if you want this to really work in your favor, especially when we talk about how to invest with this money, definitely find ways to pay back that loan. We like to use the cash flow from passive income to pay towards it. Or if you use that money to pay off some debt, the monthly payment you would be paying on that debt, you would just use that to pay towards that loan. Helping pay it down means you pay less and less interest over time. Now, if you have over $50,000 that you've built up in this account, now you start having some options with bank lines of credit. Sometimes these banks lines of credit will even be cheaper than the insurance company. So for example, some of them are based on prime. So if prime rates keep going up, this may not be the case right now where insurance companies are cheaper. But if rates come back down, say we go into another recession, right? Rates come back down, good. Because that means you can get some cheap money from the banks still with the same kind of terms where you can pay it back however, whenever you want, depending on that kind of line of credit that you received. You can actually have the interest paid back into it. Now, why would banks give you a line of credit? Because they know this money in this cash account is guaranteed. One, they know it's guaranteed to grow by at least 2, 3, 4% a year. It never loses money. But then two, they also know that they can always just get a lien against it. And so it's a secured line of credit for them. It's like a real asset they can lay claim to, which is why they give you the preferred interest rates. And the great thing is you can pay that money back interest only however you want. Now, if you want to take a loan from the insurance company, here's what you need to do. All right, you can either do one of two ways typically. One is you can do it through the insurance company directly, either by calling them up, or in some cases, the insurance companies are starting to catch up to the 21st century. Eventually, not all companies, but some companies have started to do this, and eventually, hopefully all will allow you to do this. You'll be able to take a loan online, and you can just directly transfer it to your checking account. Now, you can't request a check be mailed to you. I don't really recommend that. I don't trust the mail system that much to send a check, especially if it's a large amount. But you can just automatically transfer that money from the insurance company to your bank account. So it's really nice to do that. So again, you can call them up or you can do it online. Or the third option is you reach out to an agent. You reach out to the agent that set up the policy for you saying, can you put in the request for me? And I know in our company, we do that as a courtesy for all of our clients. And oh, here's the key thing. I know this is the question you may be asking. Do they charge me fees for this kind of loan? 0 fees. There's no origination fee. You're not being charged to borrow your own money other than the interest, right? You're just charged the interest for the loans that you get, but no fees charged from insurance agents or the insurance company at all other than just simple interest. So that's what you can do to get it from the insurance company. For banks, great thing is you can just do quick online transfers. It's super easy. Now, how do we use these loans? You can use the loans, like I said, for whatever you want. You can blow it in Vegas if you want, which I don't recommend. But you can use it for one, it could be a business startup. By the way, if you use a loan for a business purpose, you can write off the interest, just like you do if you use a credit card on your business. You can write off the interest on your taxes. So it's it's almost like a triple dip effect if you get it to make you more money there too, right? You can make money in taxes, it's still growing inside of here, and you can still use it in the business to make money here too. Many people will say if you're gonna use it for your business, you can use it for marketing purposes. Maybe you're using it to do YouTube videos, let's say for example, right? Now you have all the money still growing here, compound interest tax-free, but then you borrow it, you're able to use that money to invest there, and then you write off the interest on those loans. So now you actually get to keep more of your money. You can also use it to consolidate your own debt, so help free up some more cash flow. We have a lot of people that like to do that. More importantly, most of our clients, what they like to do with it is use it to invest. They're able to use that money because put it in a 401k, often it gets locked up and you don't have control of it, right? And it's all in the bipolar stock market, losing money. But here, you can use this to invest, buy whatever investment you want. So we have people that will borrow from it and they'll say, all right, let's buy a rental property. Well, they buy that rental property. Say that they borrow $50,000, they put in the rental property, the cash flow, let's just say is $400 a month. Take that $400 a month, pay it back towards that line of credit that you have, starts paying down that loan so that less and less gets charged in interest while this still keeps compounding in interest. You make a bigger and bigger spread. What ends up happening, I'll tell you an example. I had an example of someone where they bought an apartment building for $1 million. It was a $250,000 down payment. So they borrowed from their policy, used that as a down payment for the building. The cash flow was $2,500 a month. So they took $2,500 a month, used that to pay back towards that line of credit. And so they started paying it down. After 9 years, if you compare that to them doing that same strategy with just withdrawing from a bank savings account and doing the same thing, here's the difference. A bank savings account, if you took that $2,500 and built it back up over 9 years, you would have only made about $1,200 in interest. Using the life insurance, you make about $129,000 in interest doing the same thing. That's net return. That's even after you pay the interest and everything. You made $129,000 more. Which would you prefer? $129,000 or $1,200 bucks? It's kind of a no-brainer, isn't it? So that's huge. Had another client that actually got a bank line of credit using the cash as leverage. And guess what? He was able to get that interest rate lower on his building, and he was able to rent it out, and then eventually he was able to get the lien off of his life insurance, keeping that low payment. He was able to leverage it and make more money from his money. Now he has renters paying for his mortgage payment for him while he still has that $300,000 in his life insurance he can use to invest however he wants. So many ways to use it. Oh, bonus thing, you ever been to Disney World? The happiest place on earth? That came because Walt Disney leveraged his life insurance as collateral to put the banks at ease so they would give him loans for the rest of it, and the rest is history. You can have Disney World and all these parks because Walt Disney used his life insurance policy, his cash value as collateral to build one of the coolest amusement parks in the world. Guys, it's awesome. So many ways you can use it, more than we can even talk about in this video. By the way, I really appreciate it. If you like this video, like it, subscribe to our channel, and if you want to keep watching, check out this video, how to achieve financial independence and retire early now.